Good morning, everybody. Welcome to Fed Day. Here we are, the day we've all been waiting for. The most important Fed Day since the last one and until the next one.
Good morning, everybody. Good morning, Ryan. Good morning, Stel. So, can I eat more than today?
Can you what?
Can I eat more today? It's a fat day, you said.
Yeah, you can eat as much as you like, mate. I think that might be the best option for today.
Yeah,
just disappear, go to lunch, and come back 10 minutes before the Fed.
We used to do that when I was in Japan. We went out the whole night and then came back for the Fed at no o'clock in the morning. Don't drink.
That's the way to do it, mate. That's the way to do it. But yeah, here we are. I don't know how much more talking we can do about it, but we'll get our final thoughts out for you guys and girls today. Hope you're all getting prepped for it yourself. Let's crack on through some of the headlines overnight and the data we've seen, just to get the lay of the land. Start with the PBOC. They're out with some of their normal, I won't call them daily, but commentary that they offer now and again. Nothing really new on policy, so no signals that they're going to be looking to ease significantly further. They say that policy will remain accommodative. The economy remains broadly on track and will remain relatively stable. They did say they will improve the market-oriented floating FX rate system, which is something they have spoken about previously in terms of changing the model, going back to the I can't remember what it was called. What was it called, Kay? The other month they moved back to it.
Because I mean, Bran is trying to get into, and I was trying to look for a link to give to him. Seems like our website is not showing the link. Do you have any link to put on the on our chat, in our chat room? Perhaps. Sorry for that, Ryan.
That's all right. It should be the same link. It's always the same link on the email.
I can't give ours, right? Because
no.
Yeah, that's
what. Well, it's the same link on all the emails. The link doesn't change, so it should be. He should have it bookmarked by now. He's been coming on here long enough.
Okay, please go on, Ryan. What was the question?
Yeah, just about the PBOC and the FX thing. They did something with a fixing, didn't they? I can't remember what they called it.
Oh,
Hey guys, yeah. I'm here. Sorry, I was called to the door.
Counter-cyclical measures, Ryan?
Yeah, that was it.
Yeah, so they can use that to influence it the way that they really want. And yeah, but I've seen they put the fixing up again, right? So yeah, I think there's just in a gradual let CNH weaken a little bit scenario. I think they're rather okay. There's weak fundamentals and data, but it seems to me that they are in a little bit of a preparation for when they will reopen as well now. So you add that to the to what they are actually doing. We could see the Chinese yuan remain under pressure. What I always use is I always use their fixing as a measure. If ever we start to close below and stay below, then perhaps there's a chance of reversing this. But as long as we stay above and hold above, any interventions that we've seen in the past have not held below their fixing. So for now, I think nothing's changed in their scenario. And I really think they are letting it weaken gradually. And good morning, Stel.
Morning, Stel.
Good morning. By the way, Steve, I know I usually blame Steve, but this time it was his fault. He tried to correct the webinar hours because of the time change, and he did it 2 hours instead of 1. So now I've fixed it, and the widget is visible on the site. I wrote on the chat as well. Good morning, everybody. Are we happy to
Morning,
be here finally? FOMC day.
Yeah, exactly. And just for those who come in via your emails and the link is the same every day.
Yes.
It's not a different link every day. So if you come in via the link, bookmark your link. So if you don't get an email for any reason, or if Steve fucks it up, you've got the link bookmarked. It doesn't change.
Exactly. I have 4 bookmarks on my Chrome. Flow Show, Face, Daily, Morning Edge, Daily Roundup, and I just use those always.
And
Pornhub, yeah, of course, that too. Let's not forget about that. I was one of the founders, the seeders. Anyway. Oh man, I want today to be over.
Right, so back to the one. There's been a couple of banks out this morning calling for 750 in $1. Nomura, I think, were the ones who went first earlier today, and Citi have now pumping 750. Entirely possible, but it really does put us into some really high levels there. I doubt it's going to be one-way traffic, and I'm sure Chinese authorities will be marking some levels in there where they deem things to go too far if we continue to rally. Obviously, things could hugely change if we get confirmation at all about easing of COVID policies. On that, we had the rumours yesterday. There's not really been anything to add or take away from that. It's still all rumours. There's not, as far as I've seen, there's not been any real denials or confirmations. But it's still unlikely to happen until the early part of next year before they even make those sort of decisions. So it's still probably in the pinch of salt realm, should we call it. Right, the floodgates have been open in Japan. Tons of comments out from those guys. A lot of stuff, pretty much as we already know. There was a few news outlets making a bit of a thing of some comments from Kuroda overnight about the possibility of changing policy down the line. A bit more made of the in the headlines and the actual comments. He actually said, this was talking about changing policy on inflation, that for now, I don't see the need to raise interest rates or make any modifications to yield curve control. And he was speaking in Parliament. But if Japan sees prospects that inflation will head for 2%, accompanied by wage hikes, a tweak to monetary policy will, of course, become necessary. As I say, that some of the usual suspects in the media have made more of the headline than it actually sounds. He's pretty much stating the bloody obvious here. They are still looking for wages to rise. They are looking for inflation to be more sustained. They still think it's affected by price pressures coming from things like energy, so temporary, transitory, whatever you want to call them. And also, as far as Finance Minister Suzuki is concerned, he now says that oh, I've lost it now. He now sees that a weak yen as half the reason for inflation going higher. So a little bit made there of the headlines, but when you read into them, it's not really anything that noteworthy. But Suzuki now blaming half the reason for inflation on the weak yen, maybe, you know, emphasizes their point that they are looking at this really, really closely now. But as he also said, with regarding yen weakness, it's more about the move, not the level. As we've been stressing all the way through this, they don't put numbers on it. There may be times where businesses will put numbers on and say, you know, weakening past such and such a level brings additional problems, and that will obviously influence what the MOF look at. But it's still mainly about how the moves come around more than the levels they get to. Kay, there was a ton of headlines last night. You got any pickings?
Yeah, it's been a real avalanche, and I was a bit surprised opening my screens this morning and then going onto the onto what's been happening overnight, reading through the LiveScope night headlines, and it was an absolute avalanche. They haven't stopped the whole night. So what I make of it is that, okay, this. First of all, the Suzuki lines, I would like to come back to those. So, as you say, he sees the weak yen as a partial cause of the actual inflation, and he cannot tolerate further sharp yen weakening driven by speculators. So, there is a little bit of addition to it, is that the weak yen has been causing partially the inflation. We know that. From what's happening in the euro as well, and the ECB reacting like a turtle lying on its back with its four legs up in the air and not knowing what to do about it. But it's a little bit of an addition. I found overnight that there's been a bit of additions to what has been said before. Then there was this Kuroda saying that yen weakness is excessive, one-sided, and undesirable, and that's not new, but both have been stressing that it's weighing now on the economy, and then so that makes me think that we really have seen a lot of stealth intervention lately, and they are trying to buy time until the dollar may naturally reverse in some way. Perhaps they buy time, or they know well enough that if the Fed doesn't pivot, and looking at the interest rate differentials, looking at the trade deficits, looking at the current account deficit in Japan, the dollar yen will explode, right? They know it, so they are trying here now to buy time. But then there's another few lines, and then I want to come back on what you said, Kuroda, saying that they may tweak the monetary policy if we see the combination of higher inflation and wage hikes, and that's where the whole thing, that's where the whole problem lies in Japan, because they haven't seen any serious wage hikes for the past 20 years, and every year it's the same debate. Come the new fiscal year, March, April, we are going to see heavy debates and some ping pong games between the Japanese manufacturers and the government, one pointing fingers at the other. But perhaps this time, I will say, because never say never, perhaps this time they have some kind of reason or buffer to hike wages a bit more come the next fiscal year, because of all those stimulus packages coming from the government. So time-wise, we may be looking at the end of the fiscal year, when Kuroda will hand over the baton to his replacing person, we may perhaps see something change, but that still leaves us with 3-4 months. And then there was this, and then the line where really, that to me kills it at least, is that Suzuki said government finances will become very difficult if the Bank of Japan raises interest rates. That's where the whole thing that they have been saying for, and that was one of the last lines, right? So the whole thing that they've been saying for hours just got thrown out of the window. No, but really, no. I think now there is. It's clear that they don't want the yen to weaken further, and they are, as I said, they are trying to buy time. So they are going to throw money at it, right? That's now my kind of conviction. I'm not saying dollar yen will go down, because all the fundamentals are still against the Japanese yen right now. We are seeing energy, crude oil is finding bids on dips. The commodity sphere is not coming off further. So and with what is going on in Japan and the Japanese government watering down their own finances, I mean, all the fundamentals are still against the yen. But I'd be careful, because if they succeed to drive the speculators only half away. I've already said it yesterday. It's trading stealth interventions is much more difficult than coming in at levels, smashing it down 500 points, and then you can buy it again, the dollar yen, for instance. But what I say now is that the dollar yen, and then we're looking ahead to the Fed and what may happen. Dollar yen may be a lagger if the other dollar pairs go up. So I'm a little cautious on what's going to happen with other yen crosses right here and now. Things like if ECB doesn't really succeed to prop up the euro, things like the euro yen, things like sterling yen, things like, I don't know, well, Chinese yuan yen, for instance, could dip further. So that's a bit the mindset that I'm in right now. It's tough to buy dollar yen when they are in it all the time, you know.
Yeah,
that's what I mean, really.
Yeah,
against against actual fundamentals.
Yeah, no, I agree with you entirely, and that's the basis why I'm actually, over the longer term bearish the dollar. One, because I don't think the Fed can get any more hawkish than they are now, based on the data. But two, there has, if you're going to see a turnaround, and now we've obviously got the Bank of Japan intervening, the upside is becoming perhaps a little more difficult, even despite the trend that we're in, and we've still got to respect the trend. But that's why I'm a bit more bearish over the dollar, and particularly dollar yen. I just think you might get more bang for your buck if you've got a short dollar bias in the dollar yen than perhaps other pairs. But a question I want to ask, Kate: would Japan, would the government have been better off, rather than doing all this stimulus, just agreeing to wage rises?
No, because they're already indebted, right? I mean, Japan owns, I don't know what's the percentages of its own debt, and they're already very much indebted. That's why we have been saying for years now that the Bank of Japan is or if well, okay, we have to talk about independence and stuff like that. But in Japan, independence is a vague concept, right? We know that Bank of Japan is sponsoring the government debt and the internal debt and stuff.
But rather than putting money into people's pockets, which is what they're effectively doing with the latest fiscal measures, or some of the fiscal measures, on energy and that sort of stuff, wouldn't it be better if they put it into wages, which would mean having to issue less debt, which would mean the BOJ having to buy less, and they achieve their goals of getting inflation higher naturally, and putting money in the people's pockets, getting the companies to do it?
Okay, that's going to be, well.
Do we need a whole show for that?
No, we need two shows to cover that. But I'm going to reply in just one word. I hope demographics. They count. They're screwed. On the demographic side, I think they're absolutely screwed. Their demographics are likely to be the worst deflationary scenario in the whole of the developed world. So I think that's the really short answer. But otherwise, it's going to be an endless debate. But they're basically screwed.
Yeah. Okay. Maybe we'll save that debate for our Christmas lunch.
We could. Well, we could do a special, and I was already thinking about that. But we could do a special on some countries one day or another when the markets are, when we don't have a lot to talk about in the rest of the markets.
Yeah, definitely. And for anyone in the UK, you're more than welcome to join us. We've got a date penciled of December the 16th. For a little bit of a meetup. If you're free, you're more than welcome to join us. We'll no doubt put up the details in the chat room at some point. But yeah, that's our Christmas due date if you've got nothing planned. Right, well, let's crack on with some of the other stuff, and then we can get into the pricings. Bank of Canada's Macklem was speaking in Parliament, I believe, saying that inflation measures the bank watches have stopped their rapid rise but are not declining. He also admits that they should have hiked rates sooner. Bit of a no shit Sherlock comment there. RBNZ's Hawksby said they will consider tightening faster or slower at the next MPS or at future MPSs. This was the central bank that a few months ago said they only had 2 more hikes in them.
But wait a minute, did he eliminate? Did he just eliminate the possibility of hiking at the same pace? That's important. I'm kidding. I'm kidding. Sorry.
No,
it's
good
like
point.
these kinds of comments which add zero value. But anyway, yeah.
Are you on your surfboard right now still?
No, why?
No, just wondering.
Tomorrow morning I'll be on the catamaran. That's a different story. It's still really nice and warm here. Anyway, carry on.
Yeah. So yeah, he's again, the RBNZ was supposedly only got 2 hikes left in them. It looks like they're going to keep going anyway. ECB's Nagel said there's still a long way to go on hikes, and the ECB must be more stubborn than stubborn inflation. Typical German comments there on inflation. Very hawkish, Nagel is. ECB's cost said that progress on unwinding accommodation is significant. So the discussion on QT is gaining pace, it seems. The ECB are one bank that like to make a simple process complicated. We know they're going to do QT. Just tell us when they're doing it and when the dates are and what the numbers are. Don't keep faffing around with, oh, we have some discussion. We've not had a lot of discussion. We've had a great amount of discussion. No one gives a monkeys. Just tell us when it's coming and how much it's going to be. And until then, keep your trap shut. But anyway, the market has got a lot of focus on this QT stuff from the ECB. DeCostal says that nobody knows how far the ECB will have to raise rates. Again, we've been talking about this. Where is the ECB's terminal level, their ceiling? Where's their neutral level? It all seems a bit lower than everyone else, which, as I've been saying, is a risk that they'd be forced to go higher than even they expect. I still think that is going to be the case. We did have some fun and games yesterday from the White House. Bernstein was out with a comment, and he said that Biden endorses a Fed policy pivot. And the market went a little bit raggedy on that. And then we got a correction after, saying that he actually meant the Fed pivot to hawkish this year rather than a pivot to dovish, which they obviously haven't done. So that was fun and games late last night in the chat room when those dropped down. Reuters did a poll of FX analysts, and 30 out of 44 said that the dollar is likely to reclaim or surpass its recent highs. So a lot of dollar bulls, it seems, in the FX market at the moment. And those are the sort of guys that I'm going to be looking to fight with my bearish dollar bias. So I like it if they're all singing the same way, because their accuracy is pretty rubbish most of the time. Just going to crack a look at the data. Obviously, yesterday's data, we had some moves around. We had the ISM, which came in relatively soft in some aspects, strong in other aspects. The ISM itself came in above expectations, 50.2, although it did confirm the drop on last month. I was expecting it to do much worse, actually, as I may have mentioned, and it blew that out of the water. But we have seen some metrics that are going to cause a bit of a problem for the Fed. The prices component, 46.6, quite significant drop there. Was expected to rise, so dropped well into contraction. And then employment went back into expansion, 50.0 versus 48.7 prior. Missing expectations, but still in expansion. So 2 numbers, one inflationary, going the right way for the Fed. The other one, jobs, going the wrong way for the Fed. This has been the continuing theme. We're seeing weaker data, weaker components in terms of new orders, activity, that sort of thing. but the bits that the Fed want to see are still not all moving in unison. Now, in one sense, it begs the question, can they engineer inflation getting back to target without actually collapsing the jobs market and causing more pain than they need to, i.e. a crash landing rather than a soft landing? And I think the longer this goes, the more chance they may have at doing that, at least from the employment standpoint. If we continue to get strong employment numbers, but we start seeing inflation coming down, that's the goals really met for the Fed, or getting close to being met. So I've been one that says a crash landing is the most likely outcome. I still think the effect of rate hikes is still to be fully seen, so I still think there's problems to come. But so far, the data is saying that the soft landing may still be in play. And while the data says that, we've got to respect it. But after that, we've got the JOLTS numbers, which showed a surprise jump in job openings. Now, a lot of people were looking at the ratio between these openings and the amount of people unemployed. Obviously, if you've got 10.7 million job openings and you've got 5.735, I think, million unemployed, why aren't these people getting those jobs? And so people are looking at this ratio of how many people are unemployed versus how many openings are. Now, again, this number's not going the way the Fed wants to see it. If firms are struggling, they're not going to be putting out adverts for jobs. They're not going to be taking on people because, you know, their margins are getting squeezed or whatever. And that's how the demand drop comes that the Fed are looking for. But it seems that these job openings are rising, which doesn't suggest people are cutting back. That again is going the wrong way for the Fed. They don't want to see that effectively. So there's still a bit of an imbalance in the jobs market. It's going to get very messy. We've got the NFP coming up on Friday. We've got the ADP today. Is it today or tomorrow? I've lost track.
Today.
It should be today.
Today.
It's today. Yeah, it's today in roughly an hour and 15 minutes. So that will give us our first look at the jobs numbers. And keep an eye on that data because it could change some short-term expectations for tonight's Fed. But anyway, that was the data from the US, a bit of a mixed picture in terms of the Fed. Today we had the finals and some other PMIs data in Europe. There was some German data as well, trade balance showing a decent bounce, 3.7 billion. But look at the actual numbers, a drop in activity in both metrics. That to me is more important than the trade balance, that exports were down and imports were down. So that's showing real potential problems for Germany, as we well know, potentially heading for recession into Q4, Q1. So activity overall was down. So that's the take from that. Spain, PMI down as well, really dropping into contraction. Italy doing the same, France doing the same, Germany doing the same. So here we are again with the data all slipping back, pulling into these recession fears that we're seeing around the grounds. Whew, that was quite a lot for this morning. You guys got anything you want to add to the mix?
Not in terms of data, not in terms of data and news.
No worries, mate.
No, really, no. Don't know if Cayman has anything to say, but
Hey, you got anything you want to add to all that, mate?
You do a splendid job of covering stuff, really, you do.
Thank you very much, mate. Thank you very much.
Yeah, no, you covered everything, mate.
We're going to talk about the Fed today. Yeah, we're going to talk about the Fed. Don't worry. We're just summarizing what happened overnight and data and stuff. Yeah.
Mike, what Fed?
What? Is there a Fed today? No.
No, FAT. F-A-T.
FAT. Oh, the FAT. Yeah, we'll deal with the FAT.
Alrighty, let's go.
Yeah. So Gavin just said German banks have been downgraded to negative by Moody's and Italy too. Oh, look at that. Now, if that would have been the UK, cable would probably be trading 110 by now. But I look at the euro, it's probably going up, which in fact it did on some of the data this morning. So it just shows what people are trading on the euro. Right, so let's crack into the Fed then. I'll start first, and then I'll bring Stel in. Right, my overall position at the moment is I'm looking to fade dollar strength. I'm not going to be too concerned about what the actual finer details come out tonight. It's only if the bigger picture changes. Trading wise, yeah, I'll be looking for the snipes and the scalps, depending on the headlines and whatnot. But really, I'm positioned short dollar yen already. I'm looking to add. I'll add all the way up to the highs, up to those 151, 152 highs, if seen. And I'm playing this more for a longer term. So I'm looking for the Fed to potentially give me better levels. My main meeting is the DEC, FOMC, and the dots, because that's where I think the most important action will lie, whether the ceiling changes or not. I'm not looking to chase this lower, but in trading terms, the 145 area has to be a consideration. If you're trading just the range, you know, that's a pretty big line in the sand down there. It was the former resistance area for quite a while. So if we get a move under there, that could be significant. So from a short-term play, that's where I'll potentially be looking for longs. Not so much for a break trade if it does go lower, but it depends on how it's driven. On the upside, shorts, you can take your pick from here all the way up to the highs. Probably looking at most of the techies seems to be around the half numbers and the big figures. So that can be your rough guide. That'll be my rough guide, at least as this one is concerned. The only other dollar position I'm in, apart from dollar Hong Kong shorts, is Aussie dollar longs. Been long this for a few weeks now, down to 61.99. I'm not looking to add on any dips, though I might play the 62 level if seen, just for a short-term play. My view here is I'm more likely to play a break of that 65, 20, 40 area, both for a short-term break trade and maybe to fold some into the core long position. If we do get a break up there, I might start to chip a bit off profits if we get up to that 50 fib and the 66.50 area. Just to start putting some in the bank. But if you're looking at something like euro dollar, I'm really going to be picky on this. I'm not going to be looking to trade this one unless we get something down to these lows. If we get a really big hawkish noise out of the Fed, something that really changes the picture, these are the areas down to 95s, 96s that I'm going to be watching, because if we do get a really hawkish Fed, but we can't break those levels, that's going to really signal that we've got a potential bottom in play for euro dollar. That's what will get me interested in grabbing some longs for the longer term. Short term, the levels are there. We know what the levels are, down into 98s considerations, up to these highs in the 100s, 101s. Maybe it's going to take something to get us up to here, the 102s. That'll be your next area. I don't see anything coming from the Fed today that's going to bust us out of these ranges. So if you're looking to play the short term, pick your short term edges. Know where you're going to likely to play the stretch points. You know, if the Fed isn't too hawkish, isn't too dovish, but we get a decent move, think about where the market might get stretched and use those levels. You know, you're probably looking 100, maybe 150 pips. Those are the sort of areas either side. If the picture isn't really changing, then these ranges are likely to hold, and that's what you need to lean against for things like that. So Stel, I know you've got your eye, as usual, on the metals over the Fed. What are your thoughts, and what are you looking at?
Well, as I wrote on the chat, I don't expect Powell to be dovish. But if there is any kind of dovish shift, and I do mean something that's, you know, how do you define significant? I can't, but, you know, it's going to be a call that I'm going to make at the time. But if he's not hawkish, I'm just going to go and buy silver and platinum wherever they are trading. Not in full size yet, but I'm going to start accumulating. Having said that, as I said before, I don't think he's going to be dovish. I think he's going to probably say a little bit of the same, and the markets probably go lower. It's a tough one, and you know, I was watching a video earlier today of an interview of Fed guy Joseph Wang and ForexAnalytix. I can't remember who the host was, but it was on YouTube, done a few hours ago, and they both said one thing which I found surprising. They both said, "Yeah, you know, the Fed is going to keep going, and really, the consumer is doing very well. There's a lot of cash sloshing around the system. Look at the available cash balances on bank accounts; they're higher than they were, 3 years ago, due to the pandemic and due to the checks that were deposited basically on people's accounts." And that struck me as kind of odd, because we all know that disposable income is dropping. Everything is more important. Wages are not keeping up. Rents are not dropping yet. So disposable income is down. So okay, yes, there is a little bit more cash because there was an injection and people saved more during the pandemic, but this is so temporary. This is going to go away. It's the same as when people say, "Oh, we're releasing strategic petroleum reserves. This is really bad for oil." It's a very temporary thing. Every time they release the reserves, you see it goes down and then it goes straight back up. It's exactly the same like when the BOJ intervenes. Yes, there is a short-term reaction, and then it just goes straight back up. So for me, if I was the Fed and I was looking at that, I would say, this is not good. The people are going to go through the last of their savings now. So what happens next? So, I find that a weak argument for the Fed to be hawkish. But having said that, I do think the Fed is not going to change yet. But that's not the reason why. I think the reason why is that they're just hell-bent on bringing inflation down, and all the lagging indicators, inflation and unemployment and all of that, they're still okay. Leading indicators are dropping, but inflation is not. So as long as that's the case, they don't have a reason to stop yet. So that's my view on the Fed today.
Yeah, no, I agree with that entirely, mate. Just before
it is sorry to interrupt. It is about credibility for Powell. Mike, you're absolutely right. Yeah,
100%. Just before I hand it over to Kay, C. Northheimer said that the immediate market sentiment based on interpretation will drive the short-term movements. Later, the trend will start. You're absolutely right. And for the Fed, I've been watching this, in particular, the 2-year yield, just to see as an indication of whether the market is too hawkish, too dovish, or roundabout neutral going into the FOMC. And excuse me, it's sitting right on the neutral line. Excuse me. So 4.5% is where we're expecting the Fed to get to, 4.5%, 5%. So while something like the 2 years is sitting right on that area, I don't see the market as too hawkish or too dovish, which makes the price risk probably a bit binary going into it. I.e., the price might move an equal amount effectively, depending on whether he's hawkish or dovish or stays the path or whatever. Kay, what are you looking at, mate?
Yeah, I've just put the link of the interview on the
awesome.
In the chat here. It's Jack Farley you're talking about, the guy who was interviewing Joseph Wang about every 2 minutes. But Timelix is there. But Timelix is so October, right? We have a new one. It's Gina.
Don't give the secret away. Don't give the secret away.
We've got a new one. We've got a new one.
We've got a new one.
A new Fed whisperer is in town. What I'm looking at today is, well, I could say nothing really. I don't. Oh, do you want me to take the screen?
Yeah, go ahead, mate.
Okay, hold on one sec, because I had the window open on our stuff here. So let me. Okay, here we go. Right. I've just put on the dollar yen, but I'll talk about what I'll be looking at in the FOMC today. Basically nothing. I don't think that Jay Powell is going to change anything. We're going for 75. Already in the last statement, they talked about data dependency. I think they are just going to keep it, and because we've got a load of data coming out between today and the next FOMC, under which 2 labor reports. So that's to me going to be very, very important to watch what the labor reports are going to do, because that would be a turn there would for sure make them really think and get a few sweaty palms before they pen down the next rate move after this one. But for today, I think he will try to try very hard to avoid to say much. That's my base case. So what guidance is confirmed, I think data dependent. The next rate moves, we will see what it will be. But for now, I think he will also say that the data don't warrant a slowdown so far. Then there's going to be the QT bit. I think they are on autopilot there because so far there's not been any accidents, although and that's where to me the kicker of the day may come from, is that we've seen Yellen comment on possible liquidity issues in the treasury market, in the market itself. So that to me will be, if anyone would be so clever enough to ask him the question to comment on it, even if he could go no comments. I think that may be somewhere a kicker in today's meeting. So that's my personal view on what may happen in today's FOMC. No pivot, no nothing of the likes in my opinion. And I know I'm probably going to be the slower one of the FA community of looking for a possible pivot. Right, let's talk about the dollar yen in stuff that I'm going to be looking at. So what I was saying this morning in the chat, and I will just repeat that, is that afterwards the avalanche, the deluge of comments from the Japanese officials, if ever, and again it's not my base case, if ever we see a dovish kind of Fed, this could be the one that really moves the fastest, because they have been really leaning on it. And they've been trying to force a halt to the dollar yen right now. Of course, we know they talk about volatility and stuff, but they did actually respect what they said. The 148, 80, 85 was 300 pips above the prior intervention and stuff. So and they came back in, but leaning on it with stealth interventions, as I said, is more difficult to trade. So this one, if ever today we get a dovish tilt, a real dovish tilt, this could put pressure on the 145.5. And then to me, I've already been saying that to me, the do or die level is going to be around here, the 144.75. If that goes, that's there's going to be bad news for the dollar yen. See, Nordheimer, a 50 BPs hike would drop the dollar yen, that's for sure. I mean, because 175 BPs is baked into the cake. And in turn, if we would get no change, since BOJ is in MOF, but via BOJ are going to be in the market on really on sharp jumps, I reckon this one could be a laggard. And that's where I'm coming to what may be my secondary trade if we see a kind of hawkish, neutral to hawkish FOMC, which would send the dollar back higher. I'm going to be looking at yen crosses because I still expect the MOF and BOJ to slow moves. So this may be a hawkish FOMC today, may actually weigh on yen crosses. That is my secondary idea of going into this FOMC. So we're seeing here the euro yen. It's been starting to cap and go back down, of course helped by the interventions, but also partially helped by what the ECB is being so unclear about what their next moves may be, and today's PMI is coming in weaker. So this is going to be something that I'm going to look at after looking at dollar pairs. Keep an eye on this one. 145 is where we play ball or not. It's trading 145.5. Small bit of support perhaps here on prior lows, but if this 145 would break tonight, I think there's probably a case of going to 200, 250 points lower over time. That is one thing. The other one is going to be sterling yen. It's a little messy, my chart, I know, but I know where my mess is, so I don't care about the others. So we are could be a little bit of a flag, but this is starting to look a bit odd. Tomorrow we've got also BOE, so this is one I'm going to really pay close attention to for the combination of what we are going to see on FOMC and BOE tomorrow. We've seen a bit lower highs. We've seen it supporting here. As I said, could be a flag, but if we start to no, this is cable. Sorry, I had to go on sterling yen, which looks pretty much similar. No, okay, this is sterling yen. Sorry about that, guys. So we have seen this, as I said, could be a bit of a flag as well. But I'd be looking at 168.60, 168.40. This is one that's going to be important in my opinion. And then the big zone here is 167.50, 60. So this is one that I'm going to really pay very close attention to. If we would get some negative vibes, that means quite hawkish on the FOMC, and then perhaps BOE, which is still a possibility, underwhelmed tomorrow. So keep an eye on this is one that I'm going to keep a very close eye on. I like still looking at the metals and Stelios. I'm first of all going to silver.
Yay!
Yeah. So yesterday we had a bit of a test of this lower channel top, broke above, but then failed at 20 bucks, and now we are back inside just. So, and I know that you are looking at this very, very closely, and I am with you on this one. If we would get a dovish tilt, I think we could see quite quickly a move back to 21 bucks. What do you think?
I think so too. I think so too. And for me, the line in the sand to turn very, very bullish is a break above that trend line. So 21.40 or something like whatever that is. But yeah, I think you're right. If we do get the dovish tilt, we're getting towards 21 bucks, which is not that much, right? It's $1 and a bit.
Yeah.
And
in
but
silver
we're
we
going to
can do that. In percentage wise, it's a pretty big move, but in silver we can easily do that, right?
Yes. I agree 100%. But again, as I said before, we have to be patient. I'm not pulling the trigger yet, and they really have to change their rhetoric for me to go ahead.
Would you catch a knife if today we go, let's say, to in this zone here, 18.35.50? Would you be tempted to catch a knife? Because I'm half having the idea that if we see a move down there. This may be in a reaction to a non-dovish, let's say, FOMC. This may be a level to try and catch a knife personally, but I don't know. What do you think?
Could be with a very tight stop, but really, if the Fed is continues to be hawkish, I think we're going to take out the lows at 17.5. So I wouldn't really try that. Obviously, it could hold, but it's going to be for a very short-term trade with very defined stops. And I'm not a day trader, so I probably wouldn't do it. But I think it's not a bad idea. It's not a bad idea as long as you have your stop at the right place.
Yeah, either here or on the red line. Me thinking, which comes down from a bit longer. I know it's been crossed a lot of times, but we get it down here below 18 bucks. That would give like a quite clear stop loss level, clearer than here, for instance. Yeah. Any ideas on gold? I'm not watching platinum, so I'm. If you want to share anything, please do. But you're looking at anything in gold?
Gold looks weaker to me than silver. I mean, we're very close to the 16-14 lows, and as I've said so many times before, if we do get a hawkish Fed or a unchanged Fed, basically from what they've been telling us, I think those are going to go. So for me to change my view, we're going to have to get a dovish Fed, and we have to get above that, those previous lows, which is also the 23.6 fib that you have there. So 1679, I think, was a level or something like that. If we get above that level, oh, sorry, 1689. 1679, 17. I can't remember. Yeah, that one, 1689.
They call it 8090, right? 16.
Yeah, 8090. Remember that range?
Important.
Yeah, that range we tried so many times to break. Well, that's the new resistance. If we get above that, then I think we're off to the races. Yeah.
Okay.
I'm keeping an eye on that one. Well, if I've got enough eyes for tonight, because that 16-17 area on mine is the 50 fib. I might show it quickly when we come back. That's the 50 fib of the 2018 swing up, August 2018.
From here.
That one there. That's the 50 fib.
Yeah, I have it from here, so it comes in a lot lower. 1562 on my side. Okay, thanks. I'm looking at the clock. It's already we're already advancing quite quickly.
Yeah.
Just let me look. Huh?
No, you crack on, mate. Crack on.
Yeah, just let me look quickly at dollar China. I think today PBOC fixed above 721, and the channel comes in there as well. So I'm going to be leaning against that one. And then the last bit is if we get an okay Fed, nothing really dovish. Since I'm still not a big fan of the euro, I think some of those euro pairs could suffer a little bit more. So that's what I'll be looking at today as well. Give me a rebound into the mid 60s or 1970, 75 on euro mix. I may give it a try as well, or break below the prior low around 44, 45. I may do as well. And I'm giving it back to you, Ryan.
Yeah, thanks, mate. Thank you very much. Yeah, just that was my. Let me get it on the Sharesy. This has been my view of gold. That was my fib from this proper swing up here. That's the 50 fib that I've been keeping an eye on. I think we're in the zone for a potential nothing too hawkish, nothing too dovish type Fed. You know, 40 odd bucks away, 35 bucks away. I think that might be a decent stretch point to look at, you know, fading any move down there. My zone up here is the 75.85, you know, still stretching it to 90. Everyone's got a different pencil on this one. But that's my zonal view of that area up there. As you can see, it's been quite a sticky one, held as resistance on the last attempt there. Now, just in case you weren't aware, the prices for the platform, the ForexAnalytix platform, have gone up, but you can still get a discount if you come via Forex Flow. You can still get a 20% discount off the life of your subscription if you want to come and join us in the chat room. I'll pop the link in there for you now. There's obviously going to be a lot of coverage of the Fed. This is one of the great things about the chat room over these events. A lot of input coming from a lot of good people, a lot of good sources, and it's not all fluff and stuff you're not going to understand. People have got a good handle of what's going on, and particularly the reaction to the Fed. You know, in the seconds and minutes right after, there's plenty of people in there who can guide you, like Kay, like Stell, Lake, a lot of the other traders in there who have got a good handle of what happens. So if you want to be somewhere where you can take good advantage of what the Fed is going to do, and you're not left staring at a screen wondering what's happening, something like our chat room is where you'll get that advice and information. And also, don't forget the Good Old Traders Funding Program, which you can take advantage of here if you want to upscale your trading, trade other people's money for limited risk. Then check out the link there. I know a few of you guys in there have come in it, Brand's in the TFP. I know a lot of other guys on the Flow Show here are in it as well. So take a look at that. As I say, you can upscale your trading, get an account. Your risk is only the assessment fee. So if you pass the assessment, let's say you've got a $50,000 account. Let's say there's a black swan event, something happens, you don't trade well, you blow it up. All you've lost is the evaluation fee. You're not liable for any of the losses. It's good for anyone trading in the States because it allows you to get around the FIFO rules. So, you know, you can cut positions, add positions. You don't have to first in, first out your positions there. So you can take advantage of that. And also that gives you access, free access for varying periods, depending on which account you take, free access to the ForexAnalytix platform. And at that point, we shall call it a day. Thank you, as always, for coming to the Flow Show. Thank you to Kate and Stel, as always. Please trade safe tonight. If you're not sure, sit on your hands, let the dust settle, pick up the pieces afterwards. Don't want to hear any horror stories, but I want to hear some good stories tomorrow. So we'll have a talk about it, how you got on. Let us know your trades, how you got on tomorrow afterwards. But yeah, good luck, stay safe, and thank you to the two guys as well.
Trade safely.
Thank you.
See ya.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.